Okay, let's just jump right in. Today, we're looking at the compounding secret, why patience builds lasting wealth. We're unpacking a concept that literally defines the line between financial struggle and financial freedom. And I want to start by looking at a very specific scenario. It's the exact moment a novice investor makes a fatal error. Picture this: someone is checking their investment app. The market has just dropped by 8%. Their entire portfolio is flashing red. What they do in the next 5 seconds, it's going to entirely dictate their financial future. Which brings us to a really critical question. Why do most people quit investing exactly when they shouldn't? I want you to really consider this for a second. Why do so many people just hit the panic button and stop their investments? Say after just 1 or 2 years of starting an SIP, a systematic investment plan. They literally stop at the exact moment they should be continuing. Well, it all comes down to a battle of mindsets. It's chasing quick money versus spending time in the market. A lot of people falsely believe that investing is all about making money fast, right? Like picking the perfect stock and magically doubling your cash in a week. But in reality, successful investing requires staying long enough for your money to actually start working for you. Section 1. The biggest investing mistake: panicking at the first drop. So let's walk through a classic scenario that plays out every single day. Imagine a new investor. They do everything right at first. They start putting away 5,000 rupees a month. But then, maybe 6 months later, the market falls. Their portfolio turns negative, and the ultimate question is just staring them right in the face. Do you sell? This right here is a massive psychological trap. People look at falling markets and they immediately view them as a failure, a sign they made a huge mistake. So they get scared and they stop. But experienced investors, they know that market dips are just temporary hurdles in the wealth-building journey. The absolutely crucial point to remember is that the biggest enemy of investing isn't the market, it's impatience. That falling market wasn't destroying their future wealth, their reaction to it was. Compounding needs time. It absolutely does not need perfection. Impatience is the true destroyer here. But why do people panic so easily? I mean, if history shows us that markets generally recover and grow over the long term, why is our instinct to hit the sell button the second things look bad? Well, let's break down the psychology. Here are the three main culprits. Number one, expecting quick returns. We are totally wired for instant gratification. Number two, comparing with others' profits. We see a friend on social media bragging about some quick win, and we instantly feel like we're losing out. And number three, checking the portfolio every single day. Honestly, watching those daily fluctuations is a surefire way to drive yourself crazy and completely lose your nerve. Think of it this way. Would you dig up a newly planted mango tree every week just to check if the roots are growing? No way! That would kill the tree. But that is exactly how many people treat their early investments. You have to remind yourself that great things take time. You just gotta let the roots take hold. Section 2. The magic of compounding. What does it actually look like? Let's map out a 20-year journey assuming a 12% annual return. We'll start with this number, 12 lakh rupees. This is your foundation. If you simply put away that 5,000 rupees every single month for 2 decades, 20 years, 12 lakh is the total amount of your own money that you've invested out of pocket. Now brace yourself for this next part, 50 lakh rupees. That is the estimated final value of that exact same investment. By just leaving it alone and letting compounding do its job, your 12 lakh transforms into a staggering 50 lakh. Let's break that down even further, because this 38 lakh figure is where the real magic happens. This massive sum is what your money earned entirely on its own. Your initial 12 lakh investment effectively hired itself out and generated an additional 38 lakh in wealth, way beyond what you initially put in. That is literally your money working for you. The golden rule to take away here is simple. Time plus consistency equals wealth. But there is a way to step it up even further. See, as your career progresses and your salary grows, you shouldn't just keep your investment flat. If you slowly increase your SIP by just 10% every year, stepping it up as your income steps up, your final corpus becomes dramatically larger. Why? Because you're feeding the compounding machine more fuel while time continues to do its thing. Now, a very common beginner question usually pops up right about here. Why not simply keep your money in a savings account? I mean, it feels safer, right? It doesn't go down when the stock market drops. Well, enter the villain of our explainer, inflation.
It is the silent wealth killer that quietly reduces your purchasing power over time. It is happening right now, even while you aren't looking. Your cash is just slowly shrinking in value as grocery and petrol prices constantly rise.
And this brilliantly illustrates why savings accounts just aren't enough. Something that costs 10 lakh rupees today will cost roughly 32 lakh in 20 years, assuming a 6% average inflation rate. So if your money is just sitting in a savings account earning some low interest rate, it's growing slower than that 6% inflation rate. You are quite literally losing purchasing power safely. Your money absolutely must grow faster than inflation just to maintain its value.
Section 3. Build your financial foundation before you start investing.
Because look, before you aggressively start throwing money into the market, there are deeply pragmatic steps you absolutely must take. You don't just dive in blindly. Step 1, build a stable income. You need reliable cash flow first. Step 2 is absolutely crucial. Create an emergency fund covering 6 to 12 months of your essential expenses. Why? Because life happens, job losses happen, medical emergencies happen. Having this fund prevents you from being forced to sell your investments at the worst possible time, like at a loss during a crisis. It protects your compounding machine. So, once that foundation is built, the rule is to start small. Even 3,000 or 5,000 rupees a month is a deeply meaningful beginning. Then, increase your SIP every time your salary increases. The most important takeaway here is that consistency always beats starting big. Don't wait until you can afford to invest 25,000 all at once. Start now, start small, and just stay incredibly consistent over the years. As we wrap up this explainer, I want to leave you with this core message. Compounding doesn't reward intelligence first. It rewards patience. Surviving the ups and downs, ignoring the short-term noise, and just looking past those scary headlines. That is what ultimately builds true financial freedom. You don't have to be a genius to build wealth. You just have to be consistently patient. So I'll leave you with this final, provocative thought to reflect on today. Are you chasing quick money or are you building lasting wealth? The choice is entirely up to you. But remember, true wealth begins the exact moment you decide to give your money the time it needs to work for you. Let that sink in, and I hope this helps you start building your foundation today.